Welcome back to another monthly themes episode for the month of July. In this episode, I will cover US and global equity returns for the month and discuss changes to interest rates. I will then turn it over to Max, where he will discuss GDP, inflation, and employment for the month. And if you aren't familiar with our other videos, please check us out at convergentwealthpartners.com/blog. The story across all three major indexes were fairly similar for the month of July, despite some variance in performance. The S&P returned 2.27%, bringing its year-to-date performance to just over 17%. The Dow returned 1.25% for the month, bringing its year-to-date performance to 14.14%. And the NASDAQ 100 returned 2.75%, bringing its year-to-date performance to 17.8%. Although each major index started the month strong and finished positive, they had to recover from a sharp decline in the middle of the month, as the market responded to headlines revolving around the new Delta variant and its potential hindrance on the growth of the US economy. In Europe, European equities finished the month strong, up over 1.83%. But around the world, we saw a different story in China and emerging markets. Chinese equities finished the month well into correction territory, down over 13.8%, and emerging markets were down over 6.61%. Since peaking in April, the US 10-year Treasury yield has been trending lower, starting the month at 1.48% and finishing out the month at 1.24%, down just over 16% for the month. Now on the economic front, we'll throw it over to Max, where he'll discuss GDP, employment, and inflation.
So now we will move to the economic data portion, beginning with total claims. So despite a small bump higher midway through the month, total claims actually finished July down a bit, hovering right around about 13 million. And this represents a drop of about 18.5 million from the prior year and shows just how far the economy has come during that time. However, this level of elevated claims does present some long-term concerns for the overall strength of the economy. So despite fears of another wave of COVID lockdowns, the economy actually added about 943,000 jobs in the month of July, and this was well above estimates of about 845,000. Additionally, we saw the unemployment rate fall to 5.4%, a new pandemic low, and also well below the estimates of about 5.7%. So corporate earnings accelerated further in the first part of Q3, and really we saw massive growth across the board. However, leading the way was industrials and consumer discretionary. So coming off of the lows from Q2 of 2020, GDP surged to 12.2% on a year-over-year basis during the second quarter. Additionally, year-over-year CPI also showed massive growth, accelerating to 5.4%. And while these readings are certainly bullish on the near term, and we've seen that in the support they've provided to the markets, the really soft COVID comps are now behind us, and there's much rougher comps coming in the months ahead. And so the likelihood is that we'll expect to see some slowing during that time. And then one interesting data point that we are watching really closely is this jobs quits rate. So with the emergence of the work from home, as well as enhanced unemployment benefits, and then also the increased demand from the reopening of the economy, we are seeing workers begin to gain back some leverage. And where this is illustrated really clearly is in this jobs quits rate, which in recent months has actually spiked to all-time highs and shows just how comfortable workers are with leaving their current job in search of one with possibly better benefits. So in summary, the market had a lot of positive momentum coming off of a really strong Q2, and we've seen that in the push higher it's made in the first month of Q3. However, concerns do persist with many of the economic and political tailwinds likely to flip to headwinds in the months ahead, with the expected slowing of growth, as well as this increasing demand for long-term fiscal support. So after a massively bullish year, the market is set to face tougher challenges in the months ahead, with much of the historic year-over-year data now in the rear view. The catalyst for further market appreciation will be much harder to come by. So what does this all mean? Well, unlike in recent periods when everything in the market seemed to go up at the same time, we're now likely to face scenarios where some specific niche industries outperform while other facets of the market do underperform. We hope you enjoyed getting this deep dive into our investment research and look forward to providing it to you each quarter moving forward. Thank you from the entire Convergent team.